Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. She is one of the top global macro experts out there. Her analysis is on Real Vision TV and on many podcasts. Lyn Alden, thank you for joining me again.
Thanks for having me. Happy to be here.
So, Lyn, it's literally a clown world. It is crazy town. it seems like every 4 to 6 hours now, there's just a new crazy story coming out, whether it's problems in the Treasury market, the UK bailouts a couple of weeks ago, pension funds. What are your thoughts on all the craziness that's happening right now with the UK bailouts, the interest rate hikes, and the problems in the European Union?
So what we're basically seeing now is the Empire Strikes Back, right? And so if anyone has seen the Star Wars trilogy, the original one, you had the initial movie, and then you had a response to that, right? So if you look back in the past couple of years, we had this gigantic inflationary response. We had all these like speculations and things like that, and now we have a variety of central banks around the world, mainly the Federal Reserve, trying to fight back and regain some degree of like a stability with their currencies. And the problem is that they're about 2 decades too late. Right. So, a lot of these seeds were set in like the Greenspan era, the 90s, the 2000s. But nonetheless, with super high debt to GDP ratios, they're now trying to fight back and regain some degree of currency stability. And that's causing massive volatility in financial markets and specifically in sovereign debt markets, because that's ultimately the limiting factor when you get to the end of the road in terms of, kicking the can down the road.
And we've had 15 years since 2000, almost 15 years since 2008, 2009 of quantitative easing with asset price inflation via the Cantillon effect and zero interest rate policy. It started in the US with the Federal Reserve taking interest rates down too low for too long, inflating asset prices. But now once they start increasing interest rates, there's so much more leverage in the system with all these trades, Lyn. These pension funds, they put on these really dumb, greedy, selfish, desperate trades, I guess, for income based on the assumption, I guess, that things would stay at a zero interest rate policy, but would then once the Fed starts hiking rates and then other central banks respond, then you get currency problems with other countries besides the Fed because the dollar is rallying. We're at 113 on the dollar index right now. We're recording this interview on Friday, October 14th, 2022. It's over 113. So this is going to cause a lot of problems for Europe, the UK. They're dealing, before we started recording, we were discussing this. There's a lot of cross currents right now in the European Union that they have to deal with that the average business owner cannot accurately deal with right now.
So we've had 4 decades of structurally declining interest rates, little cyclical rises, but mainly structurally downward. And that allowed for all this debt accumulation and, asset price, appreciation as well, because, if you are measuring a stock valuation based on a 7% treasury yield, you might want a 11% return, for example. Like maybe you want a 4% equity return premium over that treasury. But if treasuries are 0% or 1%, you might want a 5% equity return because you still want a 4% equity return over that treasury, and so you're willing to pay a higher valuation due to TINA. There is no alternative, right? And so you had 4 decades of declining interest rates and higher real estate and equity valuations. And the problem is when you run into the zero bound or slightly below it, and then you also run into an energy crisis. So, we go through these historical cycles of underinvesting in commodities and especially energy. And then you get inflationary pressures from that supply situation, which have been exacerbated this cycle by ESG and other things like that. But nonetheless, you have that combination of super high debt, zero or sub-zero interest rates, and then, real world constraints. Now you're running into a problem. Now you have interest rates going sideways to up, and this year mostly up, and that puts a lot of pressure on the whole system, right? So all those like dollars, like you had dollars in your brokerage account, based on your stock valuations. You had dollars in your bank account. You had dollars in your your treasury bonds, and all of those were supposed to represent claims for real world resources, right? But when the cost of those resources go up, and then the valuations of those financialized, second, third, fourth layer derivative assets start to go down, it turns out that the vast majority of those claims are not really worth, the real world resources that they thought they were, especially if a significant portion of the population tries to call them in at once. And that's essentially what we're going through. And that's what we go through in every kind of generational disinflationary to inflationary cycle historically.
Well, we also have the amount of leverage too that these pension funds put on, and honestly, they shouldn't be putting on these types of leverage trades. Not that hedge funds, at least the risks are kind of outlined up front with a lot of the accredited investors, the institutional investors who are investing in these hedge funds. But these pension funds, a lot of them are regular people on Main Street, mom and pop people. They don't know that their pension funds have put on, desperate for income, these leverage bond trades or these leverage derivative trades. And now we're getting, I'm just hearing these stories. People are talking about Credit Suisse still. And yeah, Credit Suisse probably is a problem. There were rumors a couple weeks ago that they were potentially going to be merged by the Swiss National Bank with UBS. But I'm hearing rumors, Lyn. I just spoke on the phone a couple of days ago with a hedge fund manager who's pulling up real-time data for these, for over-the-counter derivatives, from the pension funds. They're getting enormous margin calls, many billions of dollars margin calls daily because of these leverage trades that they put in. Is that because of the lower interest rate environment? So they were looking to try to make income in a low interest rate environment. And so they added this stupid leverage onto these trades then.
So indirectly, yeah. I mean, I think we can separate the problem into the proximate cause, meaning like the immediate cause, and like the core underlying cause. And so the core underlying cause is weak money. If you have weak money, artificial low interest rates, currency that keeps devaluing, there's a very strong incentive to, borrow money and buy hard assets, right? And so that's the structure we've been in for 40 years. Now, the proximate cause is when some of those things start to blow up. And so we had a bunch of proximate causes back in the 2008 crisis. And now we're getting another wave of those. And for example, UK pensions, which are the most, kind of newsworthy, they had a variety of, programs in place where they would use their UK government bonds as collateral to own derivatives that allowed for a smoother payout period. And it's less so about speculation in the sense that they were trying to juice returns like a degenerate trader, and more so about trying to smooth their returns, knowing that they, as a pension, have a very well telegraphed and known liability payout ratio, month after month, year after year. And so they're essentially, paying for volatility reduction. And they're basing this on models that, government bonds may fall, but they can only fall by so much. And so when you have a multi-decade, century bad sell-off in government bonds, that breaks all the models. And then the problem is that every UK government pension is using the same system. And these are the biggest balance sheets in the country. And so if all the big balance sheets are selling government bonds at the same time, then the problem is that cascades, because if pension one sells their bonds to meet their collateral calls, then the prices get worse for pensions 2, 3, and 4, and they have to sell theirs as well, because that just broke the, even if they were a little bit less leveraged, they now, because the prices got worse, they have to sell theirs now. And then you have, pensions 5, 6, 7, and 8, 9, 10, they have to sell theirs now, even though if they were even less leveraged, because the prices got even worse, right? So the problem is that all the pensions use roughly the same system, with mildly different levels of risk. And it's less about, that these are just crazy casino operators, and more about, these pseudo sophisticated ways of trying to manage their liability outputs in a system that, going back to that's the proximate cause. Now, going back to the core cause, the fact that money is weak, interest rates are artificially low, and that's what allows for all of these constructs to exist to begin with, and all of these perverse incentives.
Well, also the system is too fragile. I mean, if it can't handle a couple percentage interest rate increases because of the amount of leverage in the system, how much total debt has grown since 2008, 2009, the system is far too fragile. And that's part of the problem, is how the debt since 2008, 2008 the debt since 2008 for government debt, corporate debt, it just kept growing. There was not corresponding cash flows, but these pension funds, they just added, I mean, CalPERS doesn't have a problem yet, but in 2019, they announced that they increased their balance sheet leverage by 20%. I think they said they were the first pension fund to do so, and they were going to invest in more hedge funds, private equity, and real estate. They leveraged their balance sheet by 20%. I mean, that doesn't sound like they're trying to smooth returns. It sounds like they're trying to use leverage like a portfolio manager, an investment bank, a hedge fund, or a family office.
So that's partially, and that's different than the UK system. And that's partially because they're on tilt, right? So for example, if you are in a situation where you don't see a clear path where your assets are going to meet your liabilities, one of the options is to try to take more risk to have those assets meet the liabilities. And in the small percent chance that you're right, that could work out. But of course, any sort of wise person would hear that and say, unless you're Stanley Druckenmiller, you're probably going to mess it up, and you're probably going to be even worse behind on meeting your liabilities. And so that's, again, it's just another perverse incentive of the current system of weak money. And we can tie this. I agree with your point about fragility. Like, we can tie this back to for a regular person running their own finances or running a small business. We can imagine a totally unleveraged scenario, right? So you have no debt other than maybe like a small mortgage, right? That, with a very low, kind of like a loan to value ratio, but, virtually no leverage in your business. You have cash flows, you have expenses, and your expenses are below your revenues by a considerable amount. And so you have a high savings rate. Now, if you encounter a recession and you have a bad year, it doesn't feel great, but you don't go insolvent because you don't owe anyone anything. And you have a huge buffer between your like necessary expenses and your income and cash flows, right? So you go through ebbs and flows of the economy, and you're very resilient, even though, of course, some years are more enjoyable than others. Now, to contrast with that, if you have a extremely high leverage system, which can only exist in an environment of artificiality, right? If interest rates are artificially low, if there's an artificial incentive to borrow, if money is weak compared to real assets and therefore incentivizes borrowing that weak money to buy those real assets, it builds up all this leverage in the system. And then when you have a contraction, you're in a very different environment. I mean, if you owe a lot of money and your cash flows contract, you could go insolvent a lot faster. Compared to that prior example of someone who's totally unlevered and is just riding the wave of the economy. And so we're in that second system globally, where we have super high debt to GDP ratios, debt to both on the sovereign level and the private level. And that's why we're in aggregate in such a fragile state at the current time. So you can trace it back to the individual private participants that made bad decisions, but then at the deeper level, you can tie it into the central bank and the policymaker incentives, where one, they always bail out the system when it gets bad enough, and two, they artificially lower interest rates in order to purposely incentivize higher debt accumulation.
Do you think then that pension funds are going to continue to get bailouts, that we're going to have to see wide scale bailouts? Because I'm still hearing that the margin calls, the hedge fund manager I spoke to on the phone for an hour a couple of days ago, straight up told me that these margin calls by a lot of these European, not just United Kingdom, European pension funds, a lot of them, they're unpaid. These margin calls are unpaid. So every time there's a stock market rally, these pension funds are selling shares to raise cash. They're selling what they can. They're probably selling gold. They're selling profitable stock market shares, whatever they can to raise cash to pay margin calls. Do you think ultimately these pension funds are going to have to get some type of bailout, probably even larger than the 600? I heard it was 600 billion just a couple of weeks ago for one 24-hour period for the United Kingdom, that the Federal Reserve had to give the Bank of England a $600 billion bailout, just so that way their system wouldn't have crashed with the bond yield spiking and the interest rates rising and their currency problems, because the pension funds were in that much trouble.
So for two reasons, I think yes. The first reason is somewhat a social political reason, right? So back in 2008, if you bail out the major banks, right, so you bail out the rich people, socialism for the rich, capitalism for the poor, right? So if you owned a house, if you owned a business, you faced real economic problems. Whereas if you were a bank and you were getting $1 million bonuses, you generally got bailed out and you were given liquidity at exactly the right time where nobody else had liquidity. And so you could go buy assets on the cheap, right? So we bailed out the rich people. Now you have the second layer, the second wave of the problem, where you have insolvency among people that are not super rich, pensioners, normal businesses, energy users, all these types of people. If the government then says, "Oh no, we have to be like sound, like we have to be careful about our currency," right? That's how you get riots, right? So you already bailed out the rich people, and now you're going to bail out like the rest of the people, and then you say no, right? That's where you get pitchforks, right? So from the sociological reason, you're likely to get bailouts or high pressure from the community to bail out because people will riot if their pensions just suddenly break, if all sorts of things like that, cause mayhem. And then number two, it's about the sovereign debt situation, right? So if in the 2008 crisis, the middle-sized balance sheets broke, and we pushed that up to the sovereign level. So we transferred private debt, mostly rich people's private debt, to the public sector, right, for the everyday taxpayer to deal with. And that's been in place now for like a decade or more, 15 years. And going forward, now we have a problem where, the biggest balance sheets in the world are not defaulting on their private loans, which was the case in 2008, right? So in 2008, major US banks and other banks, they were having problems with their like mortgage situation. Now they're having a problem with the sovereign bonds. So they have to sell sovereign bonds, which if you were to let that unfold, would literally cause acute liquidity crisis in the sovereign bond market. And when it comes time for the next, like say, UK sovereign bond issuance, there could be no bid if you just let that whole thing broke. If you just went like full, like zero hedge fight club, let this play out, let the buildings fall down, you could literally have a failed auction, and you would have at the worst kind of point, you'd have a default. And of course, the sovereign will never let itself get there. And so they will always bail out that higher level balance sheet if it means bailing out themselves. And so there's kind of two levers that kind of incentivize their monetization of these downstream problems that are inherently problems from things they did 10, 15, 20, 25, 30 years ago.
And to add to your points there, Lyn, if there is bond market problems in government bond markets, those lead to currency crises. So we saw that with the British pound almost breaking in one single night. That currency still having problems. The euro is having problems against the dollar. But ultimately, a lot of these policies are very similar to what Japan has done with japanification for the last 30 years. And Japan has even, it seems at least, the Bank of Japan seems to have hit its limits. So there's limits to japanification. Every country can't do it. Japan was the only country doing it for decades. So you're starting to see limits to what these central banks can actually get away with.
Exactly. And so I've actually written articles about japanification because it's a common confused subject. So for example, Japan, let's talk about pre-COVID, right? So COVID is a different subject. So pre-COVID, past 20 years pre-COVID, Japan was the biggest money printer. Their central bank, went vertical, especially from 2012 to 2019, because again, we're talking pre-COVID, and so they hit 100% central bank balance sheet to GDP, which was ahead of the curve. And people were like, well, why don't they have inflation? And so the actual answer is that Japan had the slowest broad money supply growth in the world. Right. So the actual money in people's accounts and in circulation was slower growing than the rest of the world. And that was because you had, roughly 5% annual money supply growth from monetized fiscal deficits. Right. But that was offset by a corporate deleveraging that was happening at roughly 2% per year. And so you only had about 3% annualized money supply growth, which was below average. And so you're kind of like, doing your best job of deflating a Ponzi. And they were able to do that in part because there was a global commodity bear market. And it's one of those things where if you're an aging demographic society, that's disinflationary. But if the whole world is aging, that's inflationary, right? So, but Japan was in that situation where they were alone, the most aged society, and also they had accumulated. They were super productive for decades, and so they accumulated a massive current account surplus, a positive net international investment position, and so they were kind of like a retiree that was living off of their retired, like, interest and dividends and all sorts of things like that. And so, they were unique in the world in terms of managing to hit that point and still be somewhat disinflationary. But then we fast forward to a post-COVID world and a more warlike and less globalized world for a variety of reasons. Now we have and it's just underinvestment in energy and other commodities, and so now we have a more inflationary world structurally. But we also have multiple parts of the world are aging, not just Japan, but we have Europe aging, we have China aging, and then to a lesser but still significant extent, we have the United States aging. And so the major, bulwarks of the world are aging. And I would say that is inflationary compared to just one small leading country aging. And so in this environment, I think a lot of people have that Japan model, but really it's a lot more inflationary. Now, to Japan's credit, one of the things in their advantage, like if you compare Japan to the UK, so Japan has much higher sovereign debt to GDP, but they also have way more reserves, foreign currency reserves relative to GDP than the UK does. And so, for example, if, right now we see the yen devaluing significantly, but they, and they did a little bit of an intervention for the first time in over 20 years. Like they sold like $20 billion worth of reserves to buy back their yen. That's a drop in the bucket to what they could do. They have over $1.2 trillion. So over, what is that? Over 50, over 70 times the amount of intervention they did. And, they don't want to drain their reserve. They also don't want to anger the United States allies, right, by selling too many treasuries. So they're managing that geopolitically, but they have a lot of options if they were to run into an acute crisis, like if they literally can't buy energy. Whereas the UK is in a different situation where they have very little reserves, and compared to Japan, they're actually paying they have more of a power crisis than Japan because Japan has been more pragmatic than much of Europe in terms of its energy management. And so this kind of new world of separation and fiscal monetization and things like that becomes a very country specific world, because countries are in very different shape in terms of sovereign debt levels, reserve levels, energy security levels, and it's honestly quite a mess.
And we're seeing that play out now. We're seeing currency swap line, US dollar currency swap lines being drawn by the Swiss National Bank. I think it's around over $9 billion in just the last week or so. That's probably not the real number. The European Central Bank is drawing currency swaps. We don't know the real number. The Bank of England's drawing. So all those countries that did not run trade surpluses for a long time do not have enormous foreign exchange reserves with US Treasuries to sell for cash, to sell for dollars. They're desperately accessing the emergency currency swap lines for dollars right now.
That's true, but at the same time, I mean, even the countries that actually had a lot of reserves are also doing that, right? So Switzerland has something in the ballpark of $1 trillion in foreign exchange reserves, right? They have an utterly enormous amount of foreign exchange reserves. And so it's both in the US interest and the Swiss interest for them not to, disorderly sell those reserves, right? And so I think a common issue in market commentary is the idea that the U.S. has all the power and foreign countries are entirely at the will of the U.S. government. Whereas if you just took, let's say the top 3 countries, if you had Switzerland, China, and Japan decide that their currencies are an emergency and they need to backstop them, right? So between them, they have something like $3 or $3.5 trillion in treasuries. If they were to sell, or reserves in general, if they were to sell a third of those reserves, it would cause an acute liquidity crisis in U.S. markets and probably result in a Fed response, right? So if you take an individual country, like let's say Turkey, Turkey has zero power in terms of the fact that it has more dollar liabilities than it has assets. If the dollar strengthens, it's utterly screwed. And then they have just, totally corrupt centralized policy. And so they're not raising the rates properly. And so they're having a major currency devaluation. They have no power. Whereas if you look at the top creditor nations like Japan, China, even Germany to some extent, Switzerland, Norway, right? They have major influence that if for whatever reason they decided to go to the mattresses on this, they can break US Treasury markets. And so there's kind of this like weird bilateral, like sort of like just kind of like a situation where like two people are kind of pointing guns at each other and trying to figure out how this is going to be resolved, right? So that's the current situation that we're in globally, and that's partially why it's kind of a mess.
Well, in 2021, early 2021, didn't the Fed set up a permanent foreign central bank repo facility so that there would not be disorderly selling? So these central banks, if they need dollars, they don't have to dump all their treasuries at once. They could just post them as collateral instead of selling them. They post them as collateral at this permanent repo facility for foreign central banks, and then they just get dollar loans without selling their treasuries. Or the Fed can secretly buy them, I guess, but there's no way of proving or disproving that.
Yes, but that's the example of fighting the last battle. And so if you look at the 2008 crisis, so after banks blew up, commercial banks blew up, all these major countries built like all sorts of defenses against banks ever blowing up again. So they made them like super reserve heavy. They made them much less risky in general. And then in the 2020 crisis, so the lockdown crisis, you had the sovereign bond market break. And so, foreign central banks sold treasuries to get dollars because there was a dollar shortage. And so they needed dollars, but they had more foreign assets, like dollar denominated assets than they had dollars. And so they could sell those assets, get dollars, but that broke the treasury market, that broke the US stock market. And then the Fed, again, fought the last battle and said, okay, so we're going to set up these facilities so that if foreign central banks ever like rapidly need dollars at the same time, we have these facilities in place. And if you fast forward just a couple of years to, here we are in 2022, late 2022, the same thing's kind of playing out, but it's happening much slower and for different reasons. And so there's not really a dollar shortage for the most part, other than a little bit in Europe, $6 billion or so, which is little in the global scheme. But so there's not really a global dollar shortage, but there's a problem of global dollar strengthening. And so you have multiple, central banks around the world selling treasuries, and they don't need dollars. They're not interested in borrowing dollars. They're not interested in using those standing repo facilities. But instead, they're interested in selling treasuries, not getting any dollars in return, and then just buying their own currency back in order to, set a floor under it because it's weakening too quickly. And so that's, again, an example of the Fed fighting the last battle and then being unprepared for this battle. And so I think we're in a situation where the U.S. government, the U.S. in some ways is the most advantaged situation here, right? So Russia and Europe basically sabotage themselves, right? So Russia did an attack, which, I think they were not fully prepared for the ramifications for, and their military has been, kind of weak ass. And Europe, meanwhile, totally set up their energy infrastructure to be totally reliant on Russia. So you had almost like a kamikaze between these two great powers. And Japan's a little bit caught in the middle because they rely on imported LNG and things like that, but less so, less extreme than those two. And so this gives a lot of power to the United States because all of our competitors just decided to sabotage themselves. But on the other hand, the stronger the dollar gets, the more that foreign central banks sell dollars. And because this is not as extreme and rapid as March 2020, they're not, other than like Switzerland and parts of Europe, they're not really borrowing dollars en masse at scale. and instead they're just selling dollars, buying back their own currency, and that's putting pressure on the treasury market that the Fed has to deal with, right? And so it's always like a situation where they optimize for the last battle, but then they're still unprepared for the next battle.
Well, there's multiple problems with the US Treasury market. So the way the global economy was set up on the dollar standard after Bretton Woods, when the last backing of the gold standard was eliminated, was these other countries were supposed to run trade surpluses and then recycle their trade surpluses with their foreign exchange reserves into US Treasuries. And so if these other countries, say Germany, China, Japan, Norway, a lot of these other countries that normally ran enormous trade surpluses, if they're not running trade surpluses anymore, they're not buying US Treasuries. So that's part of the problem. And then you have the Fed announcing that they're not going to buy US Treasuries. But more recently, and I was just speaking with a couple sources in the last couple of days, it sounds like the large primary dealer banks too, Lyn, they straight up told the Fed in the last couple of months due to balance sheet constraints. So these are the large US banks that are primary dealers. They are contractually responsible for buying lots of US Treasuries. They told the Federal Reserve Bank they cannot keep buying increasing amounts of US Treasuries. And yet you have the Fed saying they want to reduce the balance sheet. They want to reduce Treasury purchases. But here in DC, Lyn, both political parties, they do not want to stop spending. The majority of politicians in both parties here in DC, all they talk about is increasing spending.
Yeah, so that's actually a great point, right? So for example, primary dealer balance sheets, they're just middlemen, right? So they're contractually obligated to buy, but the reason they buy is so they can later resell. And they're linked to major U.S. banks, and so they're kind of their own buyers to some extent. But because of SLR regulations, they can only hold so many treasuries relative to their deposits, and so they really need foreign actors to buy, and they really need the Fed to buy because there's so much treasury issuance. And so when both the Fed and foreign buyers stop buying, or even worse, become net sellers, the primary dealers are like, bro, like, what do you want us to do? We can't keep buying because there's no one for us to sell to. We're selling to like,
it's supply and demand. There's too much supply of treasuries and there's not enough demand.
Exactly. So they're selling to like mom and pop, they're selling to retail, they're selling to insurance companies, but those balance sheets are smaller than the top 3 balance sheets that are selling. And so that's a problem. And so that's why, eventually you need some sort of Fed intervention, which is, Banana Republic deficit monetization, which is what we see in Japan, which is what we see in ECB to some extent for the southern countries, and is what you see in the Bank of England, right? So the Fed is really in a marginally better position, but really no structurally better position. It's kind of in the same type of position.
Well,
yeah.
Well, it seems in the last couple of weeks, things have gotten even worse. I don't know if you saw the tweets. Joseph Wang, who worked at the New York Fed, he was one of their desk traders. He put out some really interesting tweets. He showed that the Fed is no longer their bond portfolio that was bought for many years from quantitative easing because of the interest rate increases. Those are old bonds. That their bond portfolio is no longer profitable, their old bond portfolio, because of the interest rate hikes, and they're no longer remitting profits to the Treasury. And now the Fed has to pay out. They have all this cash that's parked at reverse repo, all this cash that's parked at IOER. Maybe you could explain for our listeners what IOER is. And it seems that the Fed he said they're bleeding red now in the tweets, that they're paying out way more in cash. Now, the Fed doesn't have to, they're not insolvent because they don't have to mark to market like a normal business would. But what do you think this means then if the Fed has to keep paying out more to reverse repo, more to IOER with higher interest rates, and there's not as much demand for US Treasuries?
Yeah, it's a good question. It means a couple of things. So, there were a couple of people that pointed this out ahead of time. Harris Kupperman identified this problem. And it's been something that's been pretty clear. Also, like the Reserve Bank of Australia ran into negative equity, and so basically a central bank has assets and liabilities. When they create reserves to buy, for example, sovereign bonds, they're creating liabilities to buy assets. And the problem is if you start to have a mismatch, and so they're in that situation now where, like, kind of the first time in modern history where their assets are losing value and not paying interest that matches what they owe on their liabilities. So their liabilities are things like banknotes, but also reserves for commercial banks on which they owe interest on excess reserves, and so they're paying out more to their liabilities than they're earning on their interest on their assets, while also considering their asset sales. And so, the short term problem is not that big because the way that the legal system is structured, because it took this into account, is that if the Fed starts running a deficit, normally if they generate a profit, above their excess profit, they owe the excess profit to the Treasury. They owe it to the U.S. government. But if they cease to generate that profit, instead of the Treasury owing them, the way it works is that they simply start this kind of like keeping track of that deficit, and then they don't owe any sort of profits to the Treasury until such a time in the future when they're profitable again, and then they can pay back their deficit, and then they can pay back the Treasury again, right? And so, it in a minor sense, it's not a big deal. The first order effect is that the Treasury gets less revenue from the central bank. That's number one. But number two, if this were to continue long enough, it starts to threaten central bank independence, because they're quite reliant on Treasury to kind of fund themselves conceptually, right? And so that's one of the biggest downsides for central bank negative equity, and that's why people often ask, for example, if the Bank of Japan owns half of Japanese government bonds, why can't they just forgive that debt? I mean, they already monetized it. Why can't they just forgive it? And the answer is that if they totally nuke half of their asset balance sheet, for example, while they still have the full liabilities, which is again liabilities to reserve positions at commercial banks, as well as banknotes, physical cash banknotes. They have all those liabilities. They don't have the assets anymore. And now the central bank is running on massive negative equity to the tune of trillions of dollars worth. And at that point, they lose any sort of credibility for independence, because if you're a structurally insolvent institution, you have no independence. You're entirely reliant on the government to support yourself, right? And so you have to obey the president, the prime minister. You have zero independence. And we all know that even in good times, there's like central bank independence is kind of an illusion. It's something that people pretend to agree is like legitimate, and that I think some people fool themselves into. But if you have like multi-trillion-dollar negative equity, that illusion gets marked to market, and it becomes no longer possible to pretend that the central bank has independence, and therefore the whole government becomes a banana republic. They own their own central bank, like Turkey or Argentina, and then they can just print their own money to fund their deficits.
Well, also then in that scenario, if the government is abusing its finances and the central bank their balance sheet is a mess, even if they're not marking to market and people are aware that they're taking all these bond losses and they're paying out more in interest. I mean, the foreign currency, the exchange rate of the currency, the traders are just going to attack it. The currency is going to be devalued.
Exactly, yes. And the only caveat there is if that country has a massive amount of foreign exchange reserves, like Switzerland, Singapore, Taiwan, or Japan, countries like that. They have utterly massive foreign exchange reserves, which so far they've not really tapped into. But I've described it as like kind of like mess around and find out. Like if you get too leveraged short their currencies, they can just utterly wreck you overnight with a balance sheet that is an order of magnitude bigger than yours, or multiple orders of magnitude. And so they have tools to deal with currency devaluation that countries that don't have massive foreign exchange reserves don't have, right? So if you're Turkey, if you're the Bank of England, you don't really have those tools. So that becomes a very country-specific issue.
So if the Fed keeps raising interest rates, and a lot of people are talking about 75 basis points, I heard a couple experts predict even 150 basis point increases soon. If they keep increasing interest rates, this problem that we highlighted where the Fed's paying out more, I highly recommend reading Cuppy's article, his blog article on Adventures in Capitalism from a couple weeks ago called The Fed is Screwed, where they have all these bond losses from QT. And then Cuppy highlights a problem too with paying out more in interest. Is this problem going to get exacerbated if the rate hikes increase then?
So I think yes, but I think that Fed insolvency is not the breaking issue, right? That's a long-term structural issue that I think is worth highlighting. But I think the near-term issue is the treasury market liquidity, right? And so this is something I started talking about it in 2021 when the SLR exemptions expired, and I started emphasizing it again in early 2022 when I saw this trend emerging, which is that if the Fed starts to sell bonds, and that strengthens the dollar, which means the foreign central banks are also selling bonds because they're backstopping their currency, and then you also have SLR, regulations in place so that domestic commercial banks can't buy too many treasuries relative to their deposit base. The question becomes who buys treasuries? You're still issuing treasuries. And so the problem is that the treasury market eventually goes illiquid and high yields and just literally breaks due to that problem. And we saw that, in immediate effect in the bank, in UK gilts, right? So that broke quicker. But really the US Treasury market is probably only a few months behind the Bank of England UK gilt market. And so I think that's the limiting factor first, which is that the Fed can play tough. They can pretend they're like Thanos and they're going to like break everyone else. But the problem is the more they strengthen the dollar, there are these big balance sheets like Japan and China and Switzerland that can be like, okay, bro, we're going to sell treasuries then in order to backstop our currencies. So, have fun finding buyers.
Well, also,
and that happens.
And pension funds have historically also been, and insurance companies have also historically been net buyers of US Treasuries too in the United States and Europe. But if these pension funds and insurance companies are all getting wide scale margin calls, it seems to me, Lyn, that they'd be net sellers too.
Exactly. And I think that, banks, foreign buyers, and then central banks are the biggest sellers. But then, when you trickle down, insurance companies are another potentially net seller. And then you have these like struggle retail shops that are like buying because they think that, treasuries are undervalued. You have a couple of buyers down there. But for the most part, the biggest 3 or 4 balance sheets are selling, and the smaller balance sheets are trying to buy with lower prices and bad liquidity. And I think the way to phrase this is simply that in a structural 4-decade declining interest rate, higher leverage environment, this whole system works. And then when you fast forward to now interest rates are rising because our real world constraints were underinvested in, and because our debt to GDP ratios is too high, none of this works. So central bank balance sheets don't make sense, as you point out with Cuppy's article. Bank balance sheets don't make sense unless you do SLR adjustments to have them absorb more treasuries, which I think is probably coming. Foreign central banks like Japan, Switzerland, China, they don't want to buy treasuries because they're trying to defend their own currencies, right? So who's buying treasuries, right? So all these things that have had 40 years of going in one direction are now going in the other direction. And so that's the structural issue that we're dealing with in our time.
Yeah, there's also other cross currents too, that these other countries are not writing trade surpluses, so they don't have the trade surpluses to recycle into US Treasuries. The dollar is strong, so they're probably not going to be buying as many US Treasuries if they're not writing trade surpluses, because if the dollar is strong, then their own currency is probably weak and they need to, like you said, sell treasuries to defend their own currency. And then the other part of this, which I think triggered it, is the supply chain issue. So there's a lack of goods. There's all this money supply in the system sloshing around, many trillions the last 2.5 years. So there's all this stagflation, the bad policies with the supply chains. And then the extra hammer is the lack of cheap energy and electricity, because those manufacturing countries like Japan, China, Germany, they all relied, everything was predicated for them to run trade surpluses on cheap energy and electricity, and then a US consumer that could buy their products. And so the US consumer now is tapped out, does not have discretionary income because of high interest rates, mortgages. They just don't have discretionary income that they did 12, 18 months ago. And then the profit margins for these manufacturers, they've just disappeared because of higher labor costs, energy, electricity, supply chain problems. The costs are still rising.
So that war is the key variable that made me more bullish on the dollar than I previously would have been. And now I'm at the point where, because the dollar rose so much, I'm actually getting more kind of toppy in my analysis. But if you fast forward if you go back a couple of years, I thought we'd encounter a situation where the U.S. would tighten, we'd run into problems, we would devalue, and we go from there. But then we encounter a situation instead where Russia decided to engage in their war and basically call Europe's bluff on how bad they structured their energy system, right? So, but then it turned out that even Russia's war was worse than they thought, right? I mean, their military is kind of like shitty, and so you have the situation where they can't even win the war. Europe is in a terrible energy situation, and so basically both, Russia and Europe have severely weakened themselves relative to the United States. China is somewhat in the middle, where they're able to buy cheap energy from Russia at a discount, but then they're also engaging in zero COVID perpetual policy.
China also has a housing bust and a tech bust, so they're dealing with bubbles that are credit bubbles and asset price bubbles that are collapsing.
Yeah, and they could be bailing them out, but they're not, because they're trying to deal with like zero COVID, right? So they could be printing yuan, but they're not, and so they're kind of in this like weird pseudo state. And so in that situation, the dollar strengthens significantly, but that starts breaking various foreign buyers of those treasuries. And so we've kind of like entered an accelerated period of that whole structure kind of dissolving itself. And so, if you look back a couple of years ago, Russia would provide cheap energy to Germany, which would then, due to its, very strong industrial ability, greatly amplify the value of that gas. And they'd provide, they would take billions of dollars of gas and turn it into trillions of dollars of finished parts for the world. That's now somewhat over. Multiple facilities are shutting down. And then you had a similar effect in Japan. It's less extreme because they're still able to operate, but they're much less efficient now going forward. And then the same thing is true for China. And so that all, in the long term also impacts the United States, because the strong dollar means that U.S. corporations are getting less dollars for their foreign sales, and that they're also getting higher input costs for energy, for labor, and for their foreign purchases, because they're running into various shortages. And so this whole kind of 40-year system was based on globalization, low prices, cheap energy, and now all of that is threatened by deglobalization, higher energy costs, and basically this kind of like,
and a weak dollar and a low interest rates to add to those things too.
Exactly. And so now we're in this kind of like pseudo World War III, higher interest rate, higher trade barrier environment, and that puts massive pressure on costs, which then puts massive downward pressure on U.S. equity prices. And then the problem is that the United States is among the most financialized of all economies. So our tax revenues go up structurally with higher asset prices, especially our U.S. stock prices. And so if our U.S. stock prices stop going up, that impacts high-end consumer spending, and that impacts U.S. tax revenue, while our expenses are still roughly the same. I mean, we still owe the same amount of Social Security and Medicare and military spending. If anything, many of those have gone up with inflation. And so now we have more treasury issuance into an environment where the foreign sector is not buying treasuries. And so that's where we start running into treasury market liquidity issues. And so that's why we're seeing headlines like the treasury wants to buy back its own treasuries. And that's why we see, just this various problems in the treasury market.
Plus the interest payments on the national debt are going to keep rising in the next 12, 18, 24 months, the more the Fed hikes rates, because so much of the US treasuries, our national debt, were short-term bonds that were issued. They were not 30-year bonds.
Yeah, they're probably going to hit $1 trillion. That's the current analysis. That's the current frame, point. And if you looked at a company, like let's say just a company that can't print its own currency, and it has a debt to revenue ratio that is very high, and then it's non-profitable, right? So its expenses exceed its revenue. The rating that we would place on those companies' bonds would be pretty low. We would give them a junk rating. And so most developed governments are in that boat where if you were to analyze them objectively, they would be junk bond entities. Now, of course, when you give them a central bank and the ability to print their own currency, they quickly become AA or AAA entities, but only through dilution, not through purchasing power. And so if you're in an environment like we are now, where they're not printing money, they start to run into their real kind of junk market bond status, their real, underlying supply and demand status, and it all starts to break. And so the question becomes how long can developed market central banks maintain this non-printing status? And we've already seen Japan, never tried to begin with. Europe, did a little bit kind of a middle ground where they said, okay, we're going to support the southern European countries, but not the northern European countries. But that's running into issues. We saw Bank of England try to tighten, but they broke their pension market. And now we see the US, the strongest, the 800-pound gorilla, the Federal Reserve, they're breaking their US Treasury market, and it's getting very acute at this point. And so the question becomes, what happens when multiple, all major developed market central banks have to monetize deficits despite the fact that they have high inflation? And I think that's the end game. And that's, if you go back to the prior long-term debt cycle, that's what they did in the 1940s. They basically had a situation where the central banks were captured. They had massive fiscal expenditures. They had massive inflation, massive federal debt to GDP ratios, and they had to suppress interest rates and print money in order to support it and make it money good.
And similar things happened to post World War I, except when they reset the gold standard, they set the gold standard at too low a price, as Jim Rickards said in his book, The New Case for Gold, and said in public interviews. So it seems that the policies are similar as if there was a world war. A lot of these government finances are that bad. And you've highlighted that was post World War II policy, how it was a mess with a lot of government monetization and basically inflating the debt away, right, in real terms?
Exactly. Yeah. If you held US Treasuries throughout the entire 1940s, you ended up having your yield curve cap. So, for example, on short-term Treasuries, you earned a little bit over zero. If you held long-term Treasuries, you earned 2.5%, and inflation averaged 6% during the decade and peaked as high as 19%. And so, if you average that out for the decade, you lost between 30 and 40% of your value of your purchasing power, depending on which duration of assets you owned, right? And so, and that was the winning side of the war. If you did the same thing for almost any other country, the results were way worse. And so in this current environment, the problem is that there's almost no winner, right? So, the United States is, back in the 1940s, the United States is running a trade surplus in addition to all their advantages. Now, they have a bunch of advantages, but their biggest disadvantage is that they're running a trade deficit structurally. The UK, also same thing, running a trade deficit structurally. Europe used to be running a trade surplus, but because of their energy mismanagement, they're now running a trade deficit. Japan used to be running a trade surplus. Now they're running a trade deficit. You have countries like China and Russia that are running a trade surplus, but most Westerners can't invest in Russia now. And China has this very opaque political situation. And so the overall result is
also bad accounting. I wouldn't trust a lot of Chinese companies.
Exactly.
So.
Yeah. Yeah. But one thing we do know is they have trade surplus. But even then, I mean, the problem is, what do you invest in, right? And so
commodities, stuff they have to import. Yeah,
exactly. And so you have a situation where there's very few rule of law countries that also have a trade surplus, and that's the mess we're in now. And also rule of law countries that have positive real yields on their bank account deposits and their sovereign bond yields.
A couple more questions before I let you go. So, Brent Johnson, dollar milkshake theory. A lot of people, I was talking about the dollar wrecking ball. I was making videos on it in 2019 because we had similar problems then with too much dollar denominated debt from the years prior when the dollar was weaker. They overborrowed in dollars. Kind of the global economy slows down. There's a global margin call in dollars. Now, the other part of the dollar milkshake theory that a lot of people don't talk about anymore, besides the rising dollar, is Brent is saying that all this capital investment funds from foreigners, foreign governments, foreign pension funds, foreign investors is going to come to the United States and buy stocks, bonds, real estate. But it seems to me, Lyn, that this already happened from 2009 to 2019. And we spent many minutes talking about the US Treasury, how there's not demand for Treasury bonds right now by foreigners. There's already been enormous purchases of US real estate from 2009 to 2019. US stocks are not in demand right now. So do you see then a scenario where foreigners are going to buy a lot of US assets in at some point? Or do you think the dollar milkshake is rear view mirror hindsight? It already happened. That part of the dollar milkshake theory anyway.
So I mostly think it already happened, and so I'm a big fan of Brent Johnson. I think his theory is good. And when you look at the, like, let's say the Brent Johnson versus Luke Gromen thesis, right? So you have kind of the dollar bull versus dollar bear thesis. Both of them have pretty nuanced views, and both of them I agree with in significant parts. And it all depends on the nuances of how it plays out. And so, the biggest problem with the milkshake theory. So if the dollar strengthens super far, the original milkshake theory assumes that then foreign actors then start buying more and more U.S. assets. Whereas, kind of the Luke Gromen and my thesis is that when the dollar strengthens significantly, for all the reasons that Brent outlines, you start to have foreign sector sell U.S. assets, and that's what ultimately short circuits the U.S. rise, because ultimately that breaks the Fed's ability to keep tightening because nobody's buying the treasuries, and the whole system breaks down. And so it starts to become a matter of analyzing the feedback loops to see where they kick in, and how strong they are relative to the underlying trends. And so I think what gave this kind of a amplification was that when you had Russia invade Ukraine, and even before that, when you had them start to toy around with European gas inputs, this started to break the European currency in a way that the United States did not have to deal with. And so I think that gave the milkshake theory extra legs, because that whole situation assumes kind of stable energy prices, right? And so I think in the stable energy price scenario, I think ultimately the dollar bears win. Now, when you start to include a scenario where Europe and Japan have a worse energy input situation than the United States, that strengthens Brent's case, right? So that strengthens the dollar milkshake case. Now, it's still the result that when the dollar strengthens too far, these major foreign creditor nations have to sell treasuries to get dollars, which ultimately impacts dollar markets and eventually short circuits the Fed's ability to intervene. But that's not at a higher level than it would have been, say, a year ago, before those foreign developed market energy crises. So I think that any analysis on this industry has to adjust with facts as they come in, right? So it's, you can't have just a permanent view and then stick with it no matter what happens. You have to have a structural view of how this works, but you have to have a somewhat variable input model to take into account changes that happen in terms of energy, in terms of current account balances. And so, I still think that the current dollar system as designed is unsustainable, and that can only result in so much dollar appreciation. But that level is now somewhat higher than it was before we take into account the fact that Europe and Japan would have acute energy shortages, in large part due to, Russia shutting off European natural gas.
Well, a lot of people who are who buy into Brent Johnson's dollar milkshake, strong dollar, they're anti-commodities, they're deflationistas, but I'm a top-down, bottom-up investor. I'm doing global macro analysis. I'm kind of in between Brent Johnson and Luke Gromen. I'm more of like the dollar will stay in maybe a higher trading range. The dollar tends to go in a cycle because of the different policies from governments and central banks and the treasury departments, all these finance ministries, the way they interact with each other, that ultimately, like the dollar rallying, it will top out. And then that will give maybe the Fed, if inflation comes down, the Fed will have DC Congress will have an excuse to spend more if the dollar actually, in the past, when the dollar was stronger, it was an excuse for DC to spend more. But at this point, I don't know, considering the CPI and the PPI. So we'll see what happens there. But as the bottom-up investor, though, I'm looking at the questions I always ask myself is what's cheap, what's hated, what's down 50, 60, 70%. The baby has been thrown out with the bathwater. There's good companies that have some growth if the cycle turns. So I think there's a lot of opportunities. I mean, base metals, fertilizer companies, there's energy plays, the gold miners are hated. So that's kind of what I'm looking at right now for what's cheap, what's hated. There's still low cost producers there that don't have a lot of debt on the balance sheet and potentially have some growth over the next couple of years, regardless of what the dollar does.
That's how I'm looking at it too, right? So things that have underperformed in a strong dollar environment, but they nonetheless still have good fundamentals, right? So I think a number of gold royalty companies are well positioned here. I think select emerging markets like Brazil or India and Mexico are reasonably well positioned here as small positions. I think certain value stocks, certain energy producers or energy transporters are well positioned here. I think Bitcoin is well positioned here. So I think when you look across the assets that are kind of like these anti-dollar assets, I think those are somewhat in the realm of bottoming, as the dollar is somewhat in the realm of topping. And I'm not talking about like a pico top, like not like talking about like a top, like as of this interview, but I think as you look forward to 3 to 6 months, I think we're in a position where you have to be careful about volatility, but start to look for a potential dollar top and a potential, bottom in some of these more volatile anti-dollar assets, and that those will be long opportunities, at least when they start to show a reverse momentum and or start to show Fed intervention, like the Treasury market breaks and they start to reliquify it. The Treasury Department themselves start to reliquify it. SLR adjustments. I think both technicals and fundamentals. If you start to see a fundamental reason combined with, momentum signals, kind of like, just things starting to turn up or turn down, I think that becomes a very interesting time to buy some of these under-owned, hated, kind of scarce assets that have been really held down by the strong dollar environment.
Yeah, I think the cycle will turn at some point in the next, I don't know if it's 3 to 6 months, but probably 6 to 12, because we're getting, especially for the base metal miners, we're getting to the point where these base metal miners are cash flow negative, a lot of them. They have too much debt on the balance sheet. They're going to cut supply enormously. There's not capital available. Historically, that means a lot of supply comes offline and the market starts to put in a bottom.
Yeah, I agree. I've been cautious about copper, for example, because we're still in a declining PMI environment. And so that generally is in a period where copper declines relative to gold, which is unfortunate because both gold and copper have been declining. Whereas I've been more bullish on energy because that's more like a tight constraint situation. But I think we could eventually enter a situation where both energy and base metals and precious metals could be bullish again. And I think a lot of it is tied to the dollar and tied to that PMI cycle, that Purchasing Managers Index cycle, which is basically a measure of, U.S. and global economic acceleration versus deceleration, right? So when there's deceleration, there's less construction, which means less copper demand. Whereas when there's acceleration, there's more construction, there's more physical usage, and then there's more physical usage of these base metals. So I think we're in a period where the supply of most of these commodities is tight, but because they're trying to hold down demand, there is kind of a weakness in price. But I think when we look at a year or more, I think that is unable to be sustained. And so the way I keep phrasing this is that I'm very bullish on a number of these assets over a 3, 5, 7-year period, but that I'm very uncertain over a 1, 3, 6-month period.
Yeah, the short term is very difficult to predict, but if there's no capital available, I mean, we're going to see For some of the juniors, they sell out the junior miners that don't have a mine yet, or maybe they just started a mine and it has too much debt or higher costs. They can't lower the costs. There's capital not available. We either see bankruptcies, we see shotgun weddings, like what happened with the silver miner Alexco, the small silver miner, where they were forced to sell out to Hecla because they couldn't cut costs and they couldn't raise capital. We're going to see a lot more of that, especially like for silver and base metal miners.
Yeah, I agree. I think that's generally the way that we're going. And I don't have a strong view on individual companies, but I think that's kind of the environment we're in, where the strongest ones will be able to make advantage of the situation, whereas the weakest ones get punished.
Oh, yeah. In this bear market, any bad news. So if a company does a share dilution, a company misses earnings badly, the shares are just going to get absolutely punished in this bear market environment.
Yeah, that's what we're seeing so far. And it's gone deeper than I expected, but it's not surprising considering that the Fed has hiked stronger than expected. And if going back to the 1940s versus 1970s example. So in the 1970s, you had excess demand, you had young demographics, baby boomers buying houses and things like that, and you had low sovereign debt to GDP. So the Fed tried to tighten interest rates, and that worked. In the 1940s, however, you had high debt, you did not have a lot of bank lending, and you had tight demand constraints. And so they didn't bother to try to tighten. And so I think what we're going through now is that the 2020s are very similar to the 1940s, except that the Fed is trying to tighten. Like they kind of think this is like the 1970s, where if they're tight enough, they can structurally fix inflation. Whereas I think the bigger issue is that this is more like the 1940s, and they think this is the 1970s. And so I think they can only temporarily suppress inflation before letting it rip again. And I think that's the biggest opportunity and risk in the markets.
Well, the other problem with inflation is even if the Fed keeps raising interest rates, the US imports so many things, and there's a lot of inflation and stagflation and weak currencies and rising labor costs in other countries and emerging markets. And the US trades with those countries and imports those goods and services. So the US is going to be importing a lot of this inflation from these other countries that have way worse stagflation and currency devaluations.
I agree. And that goes back to my prior point that the US is not in isolation. So, for example, if China continues its zero COVID policy, that puts a lot of pressure on Chinese manufacturing. And then two, if Europe and specifically Germany continues to shut down industry due to energy input costs, that means less food supplies, less hardware supplies, all sorts of less supplies. And so that over the course of 6, 12, 18 months, 24 months, that manifests in shortages and or inflation for the United States and the rest of the world, right? So, I've seen it very well described that basically what Germany does, Germany is a massive machine that takes several $billion of Russian gas inputs and turns it into a few $trillion worth of outputs, finished goods to the rest of the world. And now we're living in an environment where that gigantic machine is disrupted.
Yeah, Japan too.
Yeah, and Japan too. And so Japan is less disrupted than Germany, but they're still they're facing higher costs. Germany is more acutely disrupted. And so the environment there is that all the end users, they don't feel it right now, but 6, 12, 18, 24 months from now, I think they're quite likely to start feeling it.
Yeah, the costs are still rising. I mean, just because the cost for a BMW or Mercedes, if you're trying to buy it here in the United States, are up, doesn't mean the cost can't go up more. I mean, labor, it's not just energy and electricity costs. The next shoe to drop probably for a lot of these manufacturers is labor costs, because a lot of the workers are going to say, hey, if I keep my job, inflation's up enormously. Look at the consumer price index. I want some type, especially if you're unionized, we want some type of wage increase. So that's going to be another cost increase that a lot of these companies haven't added in yet.
Yeah, and they have more leverage now that there's less globalization, right? So for decades, they were impaired by the fact that, they would organize and they would say, hey, we want higher wages. And then the company would be like, nah, we're going to go buy Chinese workers, right? And so now that that's kind of largely done, companies come back to the domestic workers and like, hey, we still want those higher wages. And we just had a big inflation surge, big money printing surge, big commodity surge. We want those higher wages. And so they have a lot more bargaining power than they did 10, 20, 30, 40 years ago. And I think a lot of them are worth it. I think a lot of them have been underpaid for years. And so end consumers have basically been underpaying for years relative to the value that they're getting based on this global, kumbaya, globalization situation that we have. And then now that we don't have that, they have to pay higher costs for the things that they want, which means higher wages and higher input costs, for the worker class and for the productive inputs. And so I don't think that debt markets have adjusted fully to that yet. And I think that they're in the process of adjusting to that. But then the problem is that adjusting to that breaks the whole fiscal deficit model, which is why you run into financial repression, currency devaluation, and all these things that we discussed in this interview. And so it's kind of an inherently unstable system that I think that the end result is currency devaluation.
So last question before I let you go. Do you actively track the cost to mine Bitcoin? So Bitcoin, for listeners out there, Bitcoin, when Satoshi Nakamoto wrote the white paper, it's supposed to act as digital gold. So when I look at gold, when the paper gold price gets smashed, if it drops below a certain price, gold becomes either at or below the mining cost. So do you track this for Bitcoin as well?
So I do partially. There are specialized researchers that do a lot more detailed job than I would at tracking the specific cost, because much like gold, you have to track individual miners. There's no one cost to mine Bitcoin. It depends on the aggregate, of all miners that secure various energy and then mine Bitcoin. And so there's generally an estimatable average. And so, for example, during the peak of, if you go back to 2017 when it peaked at 19,000, we go back to 21 peak when it peaked at 69,000. Those are well above the miner cost for mining Bitcoin. Whereas now that we've crashed pretty significantly, we're back at or even below the cost of mining Bitcoin. And so, by most historical metrics over a 13-year period, we are currently at a attractive value zone for Bitcoin, which I think, that gives you no insight over a 1 to 3 year period, right? So that largely depends on Fed tightening and PMI and liquidity.
Bitcoin's risk on. Bitcoin's not not proven yet for safety and store of value yet, because the price is so volatile. I would say Bitcoin's very heavily correlated right with the NASDAQ. So I mean, it's a risk on asset for speculation.
I agree. And if you look at the historical PMI cycle, so Purchasing Managers Index, that's economic acceleration or decelerating, most of the bull markets have corresponded with rising PMI environments. And so I don't expect the next Bitcoin bull market to happen until the next rising PMI environment. Now it tends to, if anything, more closely correlate with liquidity. So it tends to bottom a little bit before PMI. So it basically it tops around the top of PMI and it bottoms a little bit before PMI, because usually central banks bottom before PMI. And so that's kind of the pattern that Bitcoin tracks. And so I do think that we have another 1, 3, 6 months of significant uncertainty. But by, going back to your prior metric of, how do we compare to mining, costs, and multiple other metrics that I track, I think we're in a deep value zone. And so I'm pretty bullish on Bitcoin. We're looking at a 3-year or 5-year viewpoint, but we still have to be very careful with 1, 3, 6 month analysis. And then, on top of that, I think that there are opportunities to invest in, say, Lightning companies. So for example, second layer companies that are building on top of Bitcoin second layer, services to provide services that have nothing to do with Bitcoin itself, right? So, for example, there are companies that, help energy companies pay for energy in real time. there are companies that do all sorts of things that have almost nothing to do with underlying Bitcoin. And so, I've been, kind of personally deploying capital into these long-term 5, 7, 10-year projects in this bear market. So kind of that contrarian, type of perspective.
Does the Bitcoin mining algorithm, does it adjust? So when Bitcoin prices fall, does it kind of understand that demand for Bitcoin might be down, the cost for Bitcoin might be rising or not falling, and then it adjusts for this?
Exactly. Yeah. That's arguably that's Satoshi Nakamoto's main thing that he invented, right? Because before him, people invented SHA-256 encryption. They invented Merkle trees. They invented proof of work. Adam Back, conceptualized that. And Satoshi Nakamoto took multiple of those things together. And one thing he added that, pretty much was unique to himself was the difficulty adjustment. So, for example, if the energy costs are too high relative to mining, more and more Bitcoin miners will go offline. They'll just stop mining because it doesn't make sense anymore. And you'll start to get slower block times. So, for example, when China just outright banned Bitcoin mining, which in hindsight ended up being incomplete because still 20% of Bitcoin mining is in China. So they could ban Twitter and it just was done. They could ban Facebook, it was done. They banned Bitcoin multiple times, it's still in China. But they did sharply at one point reduce Bitcoin mining in China, and that had a big effect on the network. And so you had slower block times, and the result is that the algorithm adjusts, right? So it says, okay, blocks are being made at a slower pace because more miners went offline. And so what it does is it says, okay, blocks are supposed to be made every 10 minutes, but in this 2-week interval, they're being made at every 12-minute increments or every 15-minute increments. And so we have to make it easier for Bitcoin miners to adjust. And so it adjusts to that situation. And the Bitcoin network doesn't have to know why, right? It doesn't, there's no like consensus, there's no council, there's no group of elders like the Federal Reserve that are monitoring the situation and deciding how much they want to cut the algorithm by. It's purely mathematical and purely in the decentralized node algorithm for how much it's going to cut it based on whether or not Bitcoin blocks are being generated every 10 minutes. And so inversely, just to finish, if you have an inverse situation, which is actually most of the time where the Bitcoin network is growing and blocks are being produced faster, then it keeps increasing the difficulty so that blocks can't be produced faster than 10 minutes. And so it's got this automatic adjustment to it.
It sounds kind of like it's a digital algorithm, as if the gold miners were talking with each other what their costs and if they should cut production. So it's kind of like that, as if the gold miners were saying, well, we're looking at our costs. The paper price for gold is down. Our costs are rising. We're not going to produce as much gold. So it's kind of similar to that. He kind of designed it based off how a gold miner would think if they could increase or decrease production quickly.
Exactly. So, for example, over time, gold miners can produce more gold. They also have input costs. But if they had a situation where they were utterly capped at how many gold ounces they could produce, then it becomes a zero-sum game. And so the weaker gold miners go out of business faster. And so, Bitcoin miners are kind of in a similar situation where the most higher cost Bitcoin miners tend to break pretty quickly when they have this situation, whereas the lowest cost Bitcoin miners are the ones that can stay in business longer. And so it's very much like commodity mining, with the difference being that the supply is capped, and so it's more of a zero-sum game than anything else.
And I strongly encourage people to go out there and read the white paper from Satoshi Nakamoto. I mean, a lot of people that have come into the Bitcoin space the last couple of years are solely speculators for higher price appreciation. But a lot of people that have been involved in Bitcoin for many, many years. I mean, I've been covering Bitcoin since I think 2011, 2012, interviewing people like Trace Meyer and others. So I read the Satoshi white paper and how he was trying to mimic or create a version of digital gold. It's just interesting that he tried to do it with an algorithm and try to track how a gold miner would think, although gold miners are not as efficient as a Bitcoin mining algorithm, unfortunately.
Yeah, I think overall for readers that are skeptical on crypto, and I've actually, I've done interviews with Doomberg and others, and these are crypto skeptical people, And I've sympathized with them because I'm also crypto skeptic, right? So anyone can spin up a cryptocurrency now that Satoshi Nakamoto figured out how to do it. But there are really only a handful of cryptocurrencies that are truly scarce, meaning that they're truly decentralized and that the supply situations are rather immutable. And among those, Bitcoin is the most so, right? And so Satoshi, created Bitcoin. He didn't have to issue capital, so it's not a security. He just kind of like invented this thing. He put it in open source. He never sold his coins. Then he left the project. It's been an evolving project from developers ever since. Very few changes, and so that it's kind of this like digital commodity that exists now that gives users the ability to send value permissionally globally or transfer value. They can memorize 12 words in their head. They can go through airports. They can arrive in another country and bring, $1 billion worth of value with them that they couldn't have done with dollars or gold. And so that's kind of a new, kind of a cloud money that exists. But of course, we always have to be on the lookout for, bugs, market share challenges, price risks, leverage risks, which we've gone through.
Lyn, the biggest risks are central bank digital currencies. So ending our freedom, governments trying to track and tax us, trying to make it illegal, making us criminals for wanting to own gold, silver, Bitcoin, these types of things, trying to tax us more. So the biggest risk is governments and their nefarious plans with cashless society, social credit score, central bank digital currencies, because it seems like they could copy a lot of the stuff for blockchain technology, put it in a centralized database, and then try to track and tax every single transaction or shut us off from our bank accounts. A lot of people said that Edward Stone, he's a lot of, I don't necessarily agree with this because he was a whistleblower and he highlighted government corruption and government's tracking us and stuff like that. But a lot of people called him a traitor and said he deserved to have his bank account shut off. But now we're starting to see lots of people having their bank accounts shut off for, I would say, very ridiculous reasons. Just making comments on a tweet or something like that, and all of a sudden their business bank accounts are shut down, PayPal threatening. So that, I think, is the biggest risk, is governments and central banks, taking this technology and then using it for nefarious purposes.
So I think that's both a risk and an advertisement for Bitcoin, right? So for example, I know a lot of people in Canada that bought Bitcoin after the Canadian banks censored the trucker protests. And so I have, even no opinion on the trucker protests. Once you realize that your banking system could just censor you, if you send money, if you send $10 to a protest you think is cool, or you agree with, right or wrong, if your bank can then censor you, you're like, wait a second, is that my money? I thought it was my money. It's not my money now. It's like censored, right? And so that whole protest was a great advertisement for Bitcoin. And I think we're seeing this around the world where, for example, Nigeria, they have a very high Bitcoin and crypto adoption ratio. And they started to see, they're a developing market, they have high inflation. And so they saw a threat to it. And so they banned Bitcoin from their banking system. So they don't have a way to enforce people to not use Bitcoin. They can't, tell people not to run full nodes. They can't tell people not to own it because they don't even know how to track it fully or how to enforce it, because it takes resources to go out, send guns to people, who are running a node and have Bitcoin. But they said, okay, here's the easy part. We're not going to let, Nigerian banks send money to crypto exchanges. And yet you still had Nigerian people do so many Telegram groups and peer-to-peer groups where they're still among the highest Bitcoin adoption countries in the world, despite the fact that their banking system totally shut it off. And it's almost like a situation where if a banking system tells you can't buy Bitcoin, that's an advertisement that in the next few years you probably want to own Bitcoin, right? Because if you're Switzerland or Singapore or the United States and maybe you have a stable currency, maybe you don't need Bitcoin for the next few years. But if you're Nigeria or
Venezuela,
Zimbabwe,
Argentina,
yeah, those people don't
Turkey.
need it. Yeah, they understand why they need Bitcoin or some combination of gold and other things. But we discussed the portability of the asset. So diversification can help. And so it's very, very hard for countries to totally ban Bitcoin, right? So, for example, again, going back to China, they banned Twitter, they banned Facebook, they banned Google. They tried to ban Bitcoin, but they're still one of the biggest mining jurisdictions for Bitcoin. And I personally talked to Bitcoin and Lightning developers in China right now that are working on Bitcoin because it's much harder to outright fully ban. All they can do is send it down to the black market, the peer-to-peer market, and that's almost like an advertisement. So there's kind of this weird trade-off between control and Bitcoin. And so even central bank digital currencies, the problem is that they, of course, still inflate at a very high rate because of the debt situation and because of politicians always want to spend without taxation. And so that if you can choose between a censored inflationary network versus a non-censored, scarce deflationary network, harder network, you would generally choose the global deflationary uncensored network over the former. And you might still back that up by owning some gold and silver and platinum and things like that. I mean, I own both. There's often this argument between
There's a
Bitcoiners
fight.
and
There's a fight between like Peter Schiff and Bitcoin and some Bitcoin people over that, and it's like neither crowd seems very interested in any type of diversification. And the environment we're in now, if you're all in on gold or all in on silver or all in on Bitcoin or all in on long US Treasuries betting on capital gains or all in on technology stocks or all in on real estate, you're getting crushed.
Yeah, and in my my real asset portfolio, my hard money portfolio, I own gold, silver, and platinum physically. And I own more Bitcoin than those things, and I own venture positions in Bitcoin companies. And I treat kind of like how for years precious metal investors treated precious metals as a hedge in case the financial system blows up, right? And so I treat precious metals as a similar hedge against the financial system and Bitcoin blowing up if something goes wrong in this 13-year-old and counting asset. And so I view that Bitcoin has tremendous potential for global savings, global transfer value, global medium of exchange, global censorship resistance against major authoritarian overreach, right? So for example, in May of this year, I spoke at the Oslo Freedom Forum in Norway, hosted by the Human Rights Foundation, and they use Bitcoin as a tool, among other tools, to deal with authoritarianism around the world, which over half the world lives in, right? So Bitcoin, much like VPNs and other things like that, is a tool to deal with a hostile financial situation. But at the same time, you have to be understanding of risks. And so I'm always happy to have that conversation for people that are maybe interested in this new technology, but that also, there's a 13-year-old ledger. They don't necessarily want to put their entire net worth in it, right? So they still want to have a hedge against, the idea that the system won't work. So they want to have physical metals, they want to have, real asset equities, and that's totally fine in my view. I think that the whole battle between gold bugs and Bitcoin maxis and things like that is overdone.
Yeah, I think it actually hurts both sides. Well, Lyn, I really enjoyed our discussion today. You are a wealth of information. If my listeners want to find your work, follow you on Twitter, how do they do so?
So I'm at lynalden.com, and I'm on Twitter at lynaldencontact, and I have a bunch of free material as well as a low-cost research service.
Great. And I'll attach links to those below the video in the information description section. I really enjoyed our conversation today. I think our listeners are going to get a lot out of it. There are a lot of crazy things happening right now, a ton of cross currents. We are living through, it seems like, currency swap lines bailouts. It seems like a repeat of, probably even worse, of 2000, considering the size of the bailouts and the derivatives and the leverage, 2008, 2009, and 2019 and 2020 all over again. We're seeing the UK repo market blow up, and then bailouts, and then all these currency swap lines. It's just a mess out there.
I agree. I think you have to just go back in time, imagine how you would invest if you were in the 1940s and you didn't know who was going to win the war. right? So you don't have the the benefit of hindsight, right? So you're in the 1940s, you're in the early 1940s. You don't know what's going to happen. You don't know all the research that's going to happen in hindsight. You have to be careful with how you invest. And I think the 2020s are a very similar environment. You want to own scarce things. You always want to prioritize self custody over external custody when possible. You want to emphasize cash flows over theoretical cash flows. You want to bring things closer to reality in that type of defensive and uncertain and diversified environment.